Imagine a world without banks. You get your salary in cash, hide it under your pillow, and pray nobody steals it. Businesses can't borrow, trade across borders is risky, and economies collapse. That's where banking comes in. The invincible financial engine that keeps money safe, businesses growing, and countries running. Today, in the very first video of the One Concept One Video series, we will break down banking from the basics you already know to the advanced deals bankers negotiate with billion-dollar companies. Stick around because by the end of this video, you will sound like a banker yourself. We will divide this complete video into 7 parts. We will start by understanding what banking actually is. Then we will explore the different types of banks. Third, we will uncover the cool things bankers really do. After that, we will look at modern banking and technology. We will also break down the risks and regulations involved. Sixth, we will explain the key banking jargons in simple language. And finally, seventh, we will walk through a real-life story of a garment exporter to see how all these pieces come together. So let's begin. What is banking? Banking is the business of managing money. At its core, every bank has 3 main jobs. The first thing bank does is accepting deposits. Instead of hiding money under your mattress, you deposit it into a bank. The bank gives you a safe place, pays you little interest, and ensures you can withdraw anytime. This creates trust because people know their money is protected. Now that your money is safely deposited, the bank doesn't just let it sit there. They put it to work. The money deposited by one customer can be loaned to someone else who needs it. Maybe to buy a house, start a business, or build a factory. This way, money circulates and fuels growth. Money isn't just about saving or lending either. It also needs to move safely wherever it's needed. Whether you're paying your electricity bills, sending money to a friend, or a company paying a supplier overseas, banks make sure money moves safely and quickly. From local transfers to international payments, banks are the trusted middleman. Think of it like this. If money is blood, then banks are the heart of the economy, pumping money to where it's needed. Without banks, money would just sit idle. But with banks, money constantly flows, helping individuals, businesses, and even governments thrive. But here's the thing. Not all banks do the same job. Some focus on individuals, others on businesses, and some handle massive financial deals or even control the entire country's money supply. That's why banks are divided into different types, each specializing in a specific role. Let's break them down. The first of its kind are the retail banks, which are also considered as our everyday bank. These are the banks you and I use daily. They handle savings account, personal loans, credit cards, and even home or car loans. They focus on individual customers, making sure your money is safe and accessible. For example, when you deposit your salary, withdraw cash from an ATM, or take a personal loan, that's retail banking. Commercial banks are the other type of banks which are mainly focused on companies and businesses. They provide business loans, working capital, trade finance, and cash management services. Commercial banks help businesses pay employees, buy raw materials, or expand operations. For instance, a garments factory getting a loan to buy new machines or pay suppliers. The third type of banks are the investment banks, which are the Wall Street type. Investment banks are the financial strategists for big companies. They help businesses raise money through IPOs or bonds, advise on mergers and acquisitions, and manage large investments. They don't usually deal with your personal savings account. It's like if a tech startup wants to go public and sell shares on the stock market, an investment bank handles that process. And finally, at the top of the hierarchy is the central bank. They're the big bosses, like the Bank of England or the US Federal Reserve. They control money supply, interest rates, and maintain financial stability. Central banks also regulate other banks, making sure the entire financial system runs smoothly. Such as during inflation, the central bank might increase interest rates to control spending and stabilize prices. So how do they all fit together? You can think of banks like a pyramid. At the bottom, retail banks serve individuals. In the middle, commercial and investment banks serve businesses and big financial deals. And at the very top, the central bank oversees the whole system like the referee of money. This hierarchy shows how money flows through the economy from people to businesses and all the way to national financial policy. Now that we know the types of banks, let's dive into the cool business side stuff that bankers actually do. The stuff your dad might talk about at work. Loans and credit analysis. Banks lend money to businesses to help them grow, but they don't just hand out cash. They carefully analyze whether the company can pay back the loan. They look at financial ratios like debt to equity, that is how much debt versus own money a company has, and interest coverage, which verifies whether if the company can pay interest from its earnings. Suppose a factory wants a loan to buy new machines. The bank checks if profits are enough to repay the loan. Only then will they approve it. Money isn't just about giving loans. Businesses also need to trade safely across borders, and that's where trade finance comes in. When companies trade internationally, sellers and buyers don't always trust each other. Banks step in to reduce that risk. They issue a letter of credit, also known as LC, which is a promise that the seller will get paid once the goods are shipped. For example, a Turkish garment company imports fabric from China. The Chinese supplier doesn't know them, so the bank guarantees if my client doesn't pay, I will. This ensures the deal happens smoothly. Big companies also need help managing all their cash, salaries, and investments efficiently. That's where corporate treasury comes in. Large companies don't just leave money lying around. Banks help them optimize daily payments, handle payroll, invest surplus cash, and hedge against currency risk or interest rate changes. A multinational company paying employees in multiple countries uses banking treasury service to make payments efficiently and avoid losses from currency fluctuations. Sometimes the projects are even bigger, like highways or power plants. In these cases, banks provide project finance. Project finance loans are based on future cash flows generated by the project itself and not just the company's balance sheet. For example, a bank funds a new toll road. The toll revenue collected over time is used to repay the loan. The bank's focus is, will this project generate enough cash to pay back? What comes next in line is relationship management. Senior bankers, often called relationship managers, don't just process forms. They negotiate with CEOs and business owners, structure complex financial deals, build and maintain high-value client relationships. For example, a relationship manager helps a big company arrange a mix of loans, guarantees, and foreign exchange deals tailored to their exact needs. Modern banking and tech. Banking today isn't just about bankers sitting behind counters and talking to clients. Technology has completely changed how banks operate, making money management faster, easier, and more secure. Let's break it down. Digital banking. Digital banking lets you do almost everything from your phone or computer. It allows you to open accounts online, pay bills instantly, transfer money via apps or QR codes, and track spending and investments. For example, you can pay your electricity bill at 10 p.m. from your phone or scan a QR code at a cafe to pay without cash. All of this is possible thanks to digital banking. But banks aren't the only ones innovating. New startups called Fintechs are shaking things up. Fintechs are financial technology startups that provide banking-like services often faster and simpler than traditional banks. Mobile wallets, peer-to-peer transfers, small loans, innovative ways to save, invest, and pay are some of the ways in which fintech is changing the transfer of cash. For instance, PayPal lets people send money instantly, pay online, or receive payments, sometimes faster and more conveniently than traditional banks. Banks now have to compete and collaborate with these fintechs to stay relevant. Behind all these scenes, banks have a complex system making sure millions of transactions run flawlessly every second. Core banking systems. Core banking systems are the software engines running every bank transaction. They ensure deposits, withdrawals, and transfers are processed 24/7. They connect multiple branches, ATMs, and online systems. They also handle billions of dollars in transactions every day without errors. When you transfer money from your bank in New York to your friend in California, the core banking system ensures the money arrives instantly and accurately. Banks handle a lot of money every day for individuals, businesses, and even governments. And with great money comes great responsibility. That's why banks face different types of risk and are heavily regulated. Credit risk. This is the most common risk banks face. If a borrower fails to repay a loan, the bank could lose money. For example, a company takes a loan to buy new machinery. But what if the business slows down and they can't pay it back? The bank must absorb the loss or try to recover it through legal action. But it's not always the loan takers who create problems. Banks also deal with risks from the market itself. Market risk. Banks invest money, lend to businesses, and deal in currencies. Changes in interest rates, stock markets, or exchange rates can affect how much money they make or lose. For example, a bank lends money to an exporter in US dollar. If the dollar suddenly drops against the local currency, the bank or the client could lose money. Now, even if the borrowers and markets are fine, banks still have to worry a lot about the operational risk. Banks run on millions of transactions every day, and mistakes, hacking, or fraud can cost a lot. Human errors, system failures, cyber attacks, or even internal fraud can impact operations. If a hacker breaches a bank system, customer accounts could be affected or the bank could lose millions. And because of all these risks, banks are heavily regulated to protect customers and the economy. There are a number of rules and regulations that keeps banks safe. Let's break them down one by one. Basel Norms. Basel Norms are international rules that make sure banks have a safety cushion. Banks lend money to individuals and businesses all the time. Sometimes loans don't get paid back. Basel Norms require banks to keep enough money aside to cover these losses. For example, if a bank gives loan worth 1 million US dollar and somehow the borrower defaults, Basel norms ensure the bank still has enough funds to stay operational and protect the depositor's money. KYC or Know Your Customer. KYC means the bank needs to know who you are. This prevents fraud, identity theft, and illegal activity. Before opening an account, you submit ID documents like your national ID or passport. This ensures that only genuine people can access banking services, keeping the system safe for everyone. For example, when you submit your ID for a bank account, that's KYC at work. The bank can now trace transactions to a real person if needed. AML or anti-money laundering. Anti-money laundering rules require banks to monitor all transactions and stop criminals from cleaning illegal money. Large or unusual deposits are flagged and investigated. This keeps money moving legally and prevents the system from being abused. For example, if someone tries to deposit huge cash from illegal sources, anti-money laundering ensures the bank detects and reports it, protecting the economy. Banking jargons explained. Bankers have their own secret language, lots of abbreviations and technical terms. First comes the very common term known as LOC or letter of credit. A letter of credit is a promise from the bank: if my client doesn't pay, the bank will. It helps sellers trust buyers in international trades. For example, a Vietnam-based garments company imports fabric from China. The Chinese supplier won't ship until they are sure they will get paid. The bank issues an LOC guaranteeing payments once the goods are shipped. Now, if the bank itself has to promise to pay on your behalf, that's called a bank guarantee. The bank assures a third party that it will cover your obligations if you default. It is often used in tenders, real estates, and large projects. An example for this can be a construction company bidding for a government project. The construction company will need a bank guarantee to show that they can fulfill the contract. If they fail, the bank pays the government instead. But what happens if the loan doesn't go as planned? That's where non-performing assets come into play. A non-performing asset is a loan where the borrower stopped paying interest or principal. A loan becomes an NPA when the borrower fails to pay the interest or principal for more than 90 days. Banks try to keep the NPAs or non-performing assets as low as possible because too many bad loans can hurt their business. For example, a small business takes a loan but goes bankrupt and can't pay anymore. Now that loan becomes the non-performing asset. Next, what comes in line is the repo rate. The repo rate is the interest rate at which commercial banks borrow from the central bank. The repo rate influences all other interest rates in the economy. Suppose if the central bank lowers the repo rate, banks can borrow cheaper and may reduce loan rates for customers. Now, what if you spend more than you have in your account? That is what we call an overdraft. Due to this overdraft, banks let you withdraw more than your account balance up to a certain limit. It is useful for short-term cash needs. For example, suppose you have 2000 US dollar in your bank account, but now you need 5000 US dollar very urgently. The bank allows an overdraft of 3000 US dollar, so that 3000 US dollar is the extra cash provided by the bank itself. This process of providing extra 3000 US dollar is what overdraft is. Now, what if you want to send your money abroad? For sending money abroad safely and quickly, banks use SWIFT. SWIFT is a global messaging system for international transfers. It lets banks communicate securely for transferring money internationally. For example, suppose a person from Philippines imports something from Germany. The Filipino importer has to pay the supplier residing in the German side. So what the bank in Philippines does is that it sends instructions via SWIFT so that the money can reach the supplier's bank accurately. There are several types of bank accounts and each serves a different purpose depending on how you earn, spend, and save your money. Let's go through the main ones. Savings account. This is the most common type of account used by individuals. It's ideal for people who want to safely store their earnings and earn a small amount of interest on it. Banks encourage saving by giving a modest interest rate and you can withdraw money whenever you need it. But there is usually a limit on the number of withdrawals per month. Current account. A current account is designed mainly for businesses, entrepreneurs, and companies that deal with frequent deposits and withdrawals. Unlike a savings account, it usually doesn't earn any interest because the purpose here is not savings but flexibility and smooth cash flow. It also allows for large unlimited transactions, which is essential for trading and operational payments. Fixed deposit. A fixed deposit is for those who want to earn higher interest by keeping their money untouched for a specific period of time, let's say 6 months, 1 year, or more. Here you deposit a lump sum and the bank rewards you with a much better interest rate than a regular savings account. However, if you withdraw before the maturity date, you usually lose some interest as a penalty. Recurring deposit. A recurring deposit is for people who prefer saving gradually rather than in one big amount. You agree to deposit a fixed amount every month for a chosen time, say 12 or 24 months, and the bank pays you interest on your total savings. It's perfect for students, young professionals, or anyone who wants to develop a disciplined saving habit. So those are the main types of bank accounts, each one designed for a specific purpose, whether it's everyday spending, business transactions, or long-term savings. Now that we understand where our money lives, let's talk about the cards connected to those accounts, credit cards and debit cards. Debit card. A debit card is directly linked to your bank account. Whenever you swipe it at a store, use it online, or withdraw cash from an ATM, the money comes straight out of your account. Here you are spending your own money, so you can only use what's actually available in your balance. Credit card. A credit card, on the other hand, lets you borrow money from the bank to make a purchase. It's like the bank paying on your behalf and you agree to repay that amount later, usually at the end of the billing cycle, which is about 30 days. If you pay the full amount on time, you are charged no interest. But if you delay payments, interest starts to build up. In short, with a debit card you spend what's yours, and with a credit card you spend what's borrowed. Now, when you work at a company, you are not just earning your monthly salary, you are also slowly building a financial cushion for your future. Two important jargons related to this are Provident Fund and Gratuity. Provident Fund. The Provident Fund is like a long-term savings account created specially for your retirement. Every month, both you and your employer contribute a small portion of your salary into this fund. It keeps growing with time and interest. The beauty of PF is that it's automatic saving. By the time you retire or leave your job, you will have built a significant amount of money through PFs. Gratuity, on the other hand, is like a reward for loyalty and long-term service. If you have worked in a company for more than 5 years, you become eligible for a one-time payment called gratuity when you leave or retire. It's the company's way of saying, thank you for staying and contributing for so long. The amount of gratuity is usually calculated based on your last drawn salary and the number of years you have worked. A common method is last drawn salary multiplied by the result of 15 divided by 26 multiplied by the number of years of service. Now let's talk about two important money transfer methods, mainly EFT and RTGS. They may go by different names or rules on the basis of each country's naming convention. EFT or Electronic Funds Transfer. EFT is a universal term for sending money electronically from one bank account to another. It's widely used around the world from the US to Europe, Asia, and beyond. The idea is simple. Instead of physically handing over cash or checks, the money moves digitally, quickly, and safely. For example, your salary in the US is credited via EFT. The employer's bank sends instructions electronically to your bank and the funds appear in your account. Whether it's paying bills, sending money to family overseas, or receiving refunds, EFT is the backbone of daily banking worldwide. RTGS or Real-Time Gross Settlement. RTGS is also a global term used in almost every country. It's designed for large value or urgent transfers and the money moves instantly and individually without waiting for batch processing. For instance, a company in India paying a supplier 50 lakh Indian rupees or a bank in the UK transferring millions to another bank uses RTGS. The key feature is speed and finality. Once the transfer is done, it's irreversible, making it ideal for high-value payments. Now let's talk about provision. Provision is one of those behind-the-scene terms in banking that most people never think about, but it's vital for a bank's financial health. At its core, a provision is money a bank sets aside as a safety cushion. Why? Because not all loans are guaranteed to be repaid. Some borrowers may default due to business failure or personal issues. If banks didn't plan for this, a few bad loans could seriously hurt their finances. And the very final term is the consortium loan. When huge projects require big loans, sometimes multiple banks team up, and that is what a consortium loan is. For mega projects, a single bank might not want to take all the risk. So a group of banks pools resources to fund the project. For example, building a new power plant might cost 500 million US dollar. Five banks come together to provide the loan so that no single bank bears the full risk. Now that we have learned about banks, their types, and their different operations, let's see all of this in action through a real-life global trade scenario. Meet Global Threads. Global Threads is a US-based clothing exporter. One day they receive a massive order from a European retailer, which is more than enough to double their monthly production. But fulfilling this order requires money, careful planning, and a lot of banking help. Before a bank even thinks about issuing a letter of credit, providing a loan, or issuing a bank guarantee, it has to know its customer well. First of all, through the KYC or Know Your Customer method, the bank collects and verifies information about the Global Threads company. Information like ownership, registration documents, key executives, and financial history. This ensures that the business is legitimate and operates transparently. Right after that, the bank checks to ensure the funds involved in transactions aren't linked to illegal activities such as fraud and money laundering. We call it the anti-money laundering method. Imagine if a bank issued an LC to a company that turned out to be a scam. The supplier could ship goods and the bank could be stuck paying a fraudulent entity. KYC and anti-money laundering protects both the bank and the trade ecosystem. Once KYC and AML is completed, the bank evaluates the company's financial health. This step is crucial before giving any credit facilities. The bank reviews financial statements, cash flow, debt-to-equity ratios, and repayment capacity to determine if the company can handle loans or guarantees responsibly. For example, if a company wants a working capital loan or an LC, the bank needs to know two things: whether if the company can repay the loan on time, and whether if there is a history of defaults or delayed payments. Now, as the initial formalities are checked by the bank, the first challenge that Global Threads face is the immediate need of premium fabrics from India. The Indian supplier won't ship without guaranteed payment. The solution? Global Threads goes to their bank and requests an LC. The bank says, "Do not worry, once your shipment is confirmed, we will pay the supplier." Due to this, the fabric can be imported without any trust issues. Now, since the payment is in Indian rupees, Global Threads needs to convert US dollar to Indian rupees. The bank handles the foreign exchange and even offers hedging options to protect against currency fluctuations. After resolving the payment concern, the next challenge would be production. Producing hundreds of thousands of garments isn't free. Global Threads needs cash to pay for worker salaries, packaging, threads, and utilities. The bank provides a cash credit facility, giving them revolving funds to cover these expenses. As they repay, the credit becomes available again. Now, the European retailer who placed the order wants assurance that Global Threads will deliver on time. The bank issues a bank guarantee on behalf of Global Threads that if Global Threads fail, the bank will pay the retailer on their behalf. After getting the bank guarantee, the buyer feels secure and the deal moves forward smoothly. Now that the shipment is sent, the buyer negotiated that they will pay after 60 days. Global Threads needs cash immediately to pay the suppliers and workers. And how will they do that? The bank offers LC discounting, that is paying Global Threads a bit early minus a small fee which the bank deducts from the initial LC amount. Imagine the LC amount was 100k US dollar and its maturity is 90 days from now. The bank discount rate is 2% for 90 days. The bank discount rate is basically the interest rate the bank charges for advancing the payment before the LC matures. As the exporter needs cash early, they opt for the discounting, and now the exporter gets 98,000 US dollar from the bank instead of the 100k US dollar. Bank collects that 100k from the importer's bank after 90 days and keeps the rest of the 2,000 US dollar as the LC discounting fee. Thus, the exporter is able to pay the salaries and the bank makes its due profit. So this is what banking is all about, from your personal savings account all the way to billion-dollar corporate deals. If you made it up until here, next time you hear words like LC, Repo Rate, or project finance, you won't just nod along. You will actually understand the world bankers live in. If you like this video, give it a thumbs up and don't forget to subscribe. Until then, keep learning, keep improving. The goal is simple, just a tad bit better, wiser, and fitter every day. I will see you guys in the very next one. The Naughty Samurai signing off.